The United States is producing more oil than ever before, more than Saudi Arabia, more than Russia. Oil fields in Texas and North Dakota are pumping at full speed. America is, by the numbers, the undisputed king of oil. That should mean booming profits, global influence, and energy dominance, right? But here's the twist. Despite record-breaking production, U.S. oil companies are bleeding money. Their profits are collapsing. Oil tankers are sitting idle. Buyers around the world are turning away. It's as if the world suddenly decided it didn't need American oil anymore. So what happened? This wasn't just a case of bad luck or market cycles. Behind the scenes, a political gamble had set everything in motion. Former President Donald Trump launched a trade war that on paper was meant to make America stronger. But instead, it triggered a global chain reaction, one that would hit the U.S. oil industry right where it hurt most. And this isn't just about oil. It's about energy power, trade routes, and even the future of transportation. Because while the U.S. was fighting for oil markets, something else was rising fast: electric vehicles. The EV revolution was quietly rewriting the rules of global demand. So how did the U.S. go from energy superpower to struggling exporter in just a few years? Let's rewind to where it all looked like a dream come true. To understand how things fell apart, we need to go back to a time when America's oil industry felt unstoppable. Between 2016 and 2018, the U.S. was riding high on what many called a shale revolution. New drilling techniques, especially hydraulic fracturing or fracking, unlocked oil reserves that were once considered unreachable. Overnight, sleepy towns in Texas and North Dakota turned into oil booms, with rigs popping up like fast food joints. Production numbers shattered records. In 2018, the U.S. became the world's largest oil producer. By some estimates, America was pumping out over 12 million barrels a day. That kind of power gave the U.S. something it hadn't had in decades: geopolitical muscle. Oil tankers carrying American crude began arriving in Europe, Asia, even China. For the first time since the 1970s, the U.S. was exporting oil in serious volumes. Headlines called it a golden age for American energy. Wall Street poured in money. Oil execs talked about energy dominance as if it were destiny. At the time, many believed the world would be hooked on oil for decades to come. It felt like America had cracked the code, and that no one could challenge its reign. But underneath that optimism, cracks were already forming. Global demand growth was slowing. Prices were unpredictable. And all that success depended on one critical thing: foreign buyers. Without them, all that oil had nowhere to go. And that's exactly where the trouble began, when politics stepped in and shook the market. In 2018, everything changed. That year, President Donald Trump launched a massive trade war. His target? Countries he claimed were taking advantage of America, especially China and the European Union. The strategy was simple: slap tariffs on foreign goods to protect American jobs and industries. But trade wars don't come without consequences. And for the oil industry, the backlash was brutal. China, once the #1 buyer of U.S. crude oil, didn't just complain, they hit back hard. Almost overnight, they slashed their purchases of American oil by a staggering 90%. One month, U.S. tankers were regularly docking in Chinese ports. The next month, they were being turned away. It was like building a restaurant that serves one main customer. And then that customer stops showing up. The numbers don't lie. In 2017, U.S. oil exports to China peaked at nearly 500,000 barrels per day. By late 2018, that number had collapsed. Trade data showed a dramatic nosedive, like someone had pulled the plug on a fast-growing business. And China wasn't alone. The European Union and others also responded with their own tariffs, squeezing American energy exports even more. What made it worse was timing. Just as the U.S. oil industry was expanding, hoping to dominate world markets, its biggest clients were suddenly shutting their doors. This wasn't just a political fight. It was a punch to the gut of an industry that had just started to believe it was untouchable. And as we'll see next, that punch set off a domino effect around the world. Once China cut off U.S. oil, it sent a loud message to the rest of the world. American crude was no longer a safe bet. Global buyers took notice. Countries like India, which had been increasing purchases of U.S. oil, started to rethink their strategies. Even Europe, which had welcomed American oil as a way to reduce dependence on Russia, began to hesitate. Why risk getting caught in a trade war crossfire? So they pivoted. Instead of U.S. oil, many turned to other suppliers: Russia, Iran, and Saudi Arabia. These countries were more than happy to step in. Russia, in particular, began offering heavily discounted crude oil, especially a grade called Urals crude. It wasn't as high quality as American light sweet crude, but it came at a cheaper price, and with no political baggage. This gave global refiners a clear choice: deal with unstable trade policies and potential tariffs from the U.S., or get reliable discounted oil elsewhere. The result? U.S. oil lost its price advantage. What once looked like an unbeatable product, affordable, high-quality oil, was now being passed over because of politics. This wasn't just bad news for sales. It was a deeper hit to the image of U.S. energy. If buyers couldn't count on it, they wouldn't invest in it. And that shift started pulling money, deals, and long-term contracts away from the U.S. And when customers leave, the bills don't stop. American oil producers were still deep in debt, and now their main lifeline, exports, was drying up. That's when the financial side of the story began to crack wide open. Behind the scenes of the shale boom, there was a dangerous secret debt. During the Golden Age, shale oil companies borrowed massive amounts of money to drill and expand fast. It worked, as long as oil prices stayed high and global buyers kept paying. But once the trade war scared off customers, everything changed. With fewer buyers, prices dropped. Suddenly, the profits that were supposed to pay off those loans started disappearing. Many shale companies found themselves trapped. They owed banks billions, but weren't making enough money to cover it. Wall Street saw the danger and began backing away. Investors who once bet big on U.S. energy began pulling their funds. One after another, shale firms started to collapse. The most famous example? Chesapeake Energy. Once a giant in the fracking world, Chesapeake had helped lead the Shale Revolution. But by 2020, crushed by falling prices and growing debt, the company declared bankruptcy. It was a symbol of a wider crisis. Shale oil wasn't just in trouble, it was falling apart. The industry had become a victim of its own speed. It grew too fast, borrowed too much, and didn't plan for a world where buyers could vanish overnight. And just as America's oil giants were stumbling, its global rivals saw an opening. When the U.S. shale industry started to wobble, OPEC Plus saw its chance and went for the jugular. In early 2020, a major disagreement between Saudi Arabia and Russia exploded into a price war. Instead of cutting oil production to support prices, both countries did the opposite. They flooded the market with cheap oil. The goal was simple: kill off American shale. They knew U.S. shale producers needed oil prices to stay above a certain level, often around $50 to $60 per barrel, just to break even. But with OPEC Plus flooding the market, oil prices crashed to $30, then below $20, and in some cases even lower. This move wasn't random. It was strategic. By turning on the taps, Saudi Arabia and Russia forced U.S. producers into a corner. With prices so low, American companies couldn't cover their costs. More bankruptcies followed, rigs shut down, and thousands of oil workers lost their jobs. It was like a giant chess game, and OPEC Plus made a brilliant move. While U.S. companies scrambled to survive, countries like Saudi Arabia could afford to sell cheap oil for longer. Their production costs were much lower, and they had government backing to wait out the storm. This moment marked a turning point. The U.S., which once looked like it could dominate global energy markets, was suddenly being pushed to the sidelines. But as bad as things were, the worst was yet to come. Just as the oil industry was trying to recover from price wars and trade shocks, a quiet revolution was already gaining speed: electric vehicles. Even before COVID-19, something was changing in the global energy market. For decades, oil demand kept growing. But by 2019, that growth started to slow, and the reason was simple: more people were driving EVs. In Europe and China, EV adoption was accelerating fast. Countries were offering subsidies, tax breaks, and free charging to encourage people to switch from gas-powered cars, and people responded. In Norway, electric cars made up more than 50% of new vehicle sales. In China, they hit over 1.2 million sales in 2019, and automakers were building dozens of new models. Even countries like the Netherlands, Germany, and the UK were announcing future bans on gas and diesel cars. Why does this matter for oil? Because transportation, cars, trucks, planes, is the single biggest reason the world uses oil. If electric vehicles take over, demand for gasoline crashes. And when that happens, oil companies lose their most important customers. Investors saw the writing on the wall. Major funds began pulling money from fossil fuels and shifting it toward green energy and EV tech. Oil companies weren't just dealing with trade wars and price crashes anymore. They were losing their future. The fear wasn't just about today's prices. It was about what's coming next, a world where people don't need oil at all. And then came the final blow, a global pandemic that brought the entire oil market to its knees. If the trade war, debt crisis, and price war weren't enough, COVID-19 delivered the knockout punch. When the pandemic hit in early 2020, countries around the world went into lockdown. Planes were grounded, highways emptied, factories shut down. Almost overnight, the demand for oil vanished. Suddenly, no one was buying. Oil producers were still pumping, but there was nowhere to send the oil. Storage tanks filled up, pipelines backed up, and oil tankers were stranded at sea with nowhere to unload. The system was overwhelmed. Then, something happened that had never happened before in history. On April 20th, 2020, the price of West Texas Intermediate, a major U.S. oil benchmark, collapsed to negative $37 per barrel. Yes, negative. That meant sellers were literally paying buyers to take oil off their hands. It was a symbol of just how broken the system had become. U.S. oil, once a shining example of American energy power, was now so unwanted it had become a liability. And remember, this disaster didn't come out of nowhere. COVID-19 didn't start the fire, it just made it burn out of control. The trade war had already pushed buyers away. OPEC's flood had crushed prices. EVs were chipping away at future demand. And now, with no one traveling or driving, oil had nowhere to go. This moment, the negative oil price, marked a historic collapse. One that reshaped how investors, governments, and energy companies thought about the future of oil. But even as the world began to recover from the pandemic, the U.S. oil industry faced unprecedented challenges. After the chaos of the pandemic, a new president entered the White House, Joe Biden, and with him came a big shift in how the U.S. approached energy. Where Trump had pushed for energy dominance and rolled back regulations to help oil companies drill more, Biden went in the opposite direction. His administration focused on climate change, clean energy, and cutting carbon emissions. That meant new challenges for oil. First, Biden tightened rules on oil and gas drilling. He paused new leases on federal land, increased scrutiny on permits, and brought back stricter environmental reviews. These actions didn't kill the industry, but they made it harder, slower, and more expensive to expand. Next came the Inflation Reduction Act in 2022, a law packed with clean energy incentives. It included billions of dollars in subsidies for electric vehicles, solar panels, wind farms, and battery factories. For investors, the message was clear. The future is green. Suddenly, the money that once flowed into oil was heading elsewhere. Wall Street began pouring funds into EV startups, battery tech, and green hydrogen. Even big oil companies like ExxonMobil and Chevron started investing in carbon capture and low-carbon fuels. Not because they wanted to, but because they had to. At the same time, car companies like Ford and GM announced major electric vehicle lineups, racing to catch up with Tesla and meet stricter emission rules. All of this created another layer of pressure on U.S. oil. Even if companies managed to drill more, the long-term demand picture looked weak, and government policy was now actively pushing the market away from fossil fuels and toward clean alternatives. For the oil industry, this wasn't just a regulatory challenge, it was an identity crisis. And nowhere was that shift more obvious than in the global leader of the EV movement, China. China is like the heavyweight champion in the electric vehicle arena, and its story sharply contrasts with the U.S. oil industry's struggles. In recent years, China has pushed massive investments into EV manufacturing, battery technology, and charging infrastructure. It's not just about cars, it's about building an entire clean energy ecosystem. To put it in perspective, China accounts for about 30% of global EV sales, more than any other country. They have companies like BYD and NIO that are racing ahead in battery tech, often beating Western automakers in price and innovation. At the same time, China has deliberately cut back on buying U.S. crude oil, especially after the trade war began. Instead, it imports oil from Russia, the Middle East, and even its own domestic production. So what does this mean? China's EV boom is indirectly but powerfully killing demand for U.S. oil. While American shale producers are struggling to find buyers, Chinese EV sales continue to surge, reducing the need for gasoline and diesel imports. It's like two stories happening side by side. On one hand, the U.S. oil industry is facing collapse due to shrinking markets and growing debt. On the other, China is speeding ahead in clean energy, building a future that leaves oil behind. This contrast shows a bigger global trend, not just trade disputes or short-term shocks, but a fundamental shift in energy power. And while China's rise changes the energy landscape, it also creates openings for other global players. As U.S. oil stumbled, two old rivals quietly strengthened their grip on the global market: Russia and Saudi Arabia. First, Russia turned to what analysts call the shadow fleet. When Western insurers and ports refused to handle Russian oil, especially after 2022 sanctions, tankers began quietly reflagging and using ship-to-ship transfers at sea. This hidden network kept Russian crude flowing to hungry buyers in Asia and Europe, often at deep discounts. In effect, Russia bypassed the rules and locked in new long-term deals, securing revenue when Western markets were off-limits. At the same time, Saudi Arabia used its vast reserves and low production costs to lock in Asian contracts. With OPEC Plus controlling output cuts, Riyadh offered stability in a turbulent market. Buyers from China and India signed multi-year agreements, betting on Saudi reliability rather than risky U.S. shale fields. These deals weren't just about price, they were about securing energy for decades to come. Together, these moves reshaped global alliances. Russia and Saudi Arabia replaced the U.S. as top suppliers to fast-growing markets, from Mumbai to Shanghai. They didn't just win market share, they won influence, deepening ties through investment in refineries, ports, and pipelines. Meanwhile, American producers watched as their customers and cash flows migrated eastward. What once looked like a runaway U.S. energy juggernaut was now a fading powerhouse, sidelined by two established players forging a new energy order. And as these geopolitical giants solidified their positions, the clock kept ticking on oil's future, threatened not just by politics but by the unstoppable rise of electric vehicles. Amid the global energy shakeup, one company emerged as the ultimate game-changer: Tesla. While governments and big automakers tiptoed into electric mobility, Tesla charged ahead with bold moves, pioneering massive battery factories and cutting EV prices to levels that surprised everyone. In 2020, Tesla unveiled its 4,680 battery cell, promising higher energy density and lower production costs. Imagine swapping out the engine in your sedan for a battery pack that fits more power into the same space. Suddenly, EV range climbs past 300 miles, and charging stops feel like a quick coffee break rather than a long pit stop. At the same time, Tesla's shift to lithium iron phosphate, or LFP, chemistry for standard models drove down costs even further. LFP batteries trade a bit of range for big gains in safety, lifespan, and affordability, so more drivers could join the electric revolution without breaking the bank. These breakthroughs didn't just boost Tesla's sales, they set off a chain reaction. Legacy automakers scrambled to catch up, announcing their own battery plants and slashing EV prices. Suddenly, electric cars became cheaper than some gas models in key markets, eroding oil's last stronghold: everyday transportation. With Tesla pulling the industry forward, the future of oil looked bleaker than ever. And next, we'll ask, is there any path for U.S. oil to recover? Even after everything we've seen, trade wars, debt crises, price collapses, electric vehicle upswings, some wonder if American oil can claw its way back. The answer? Only if it navigates through a very narrow set of circumstances. First, there's the political route. Imagine a future president decides to repeal those trade tariffs, reopen Chinese and European markets, and slash red tape on drilling. That could lower costs and attract buyers back. But reversing years of policy takes time, and in the meantime, rivals keep building new partnerships and infrastructure. Second, there's the regulatory path. If the U.S. were to streamline permitting on federal lands and fast-track pipeline approvals, producers could ramp up output more cheaply. That might help some high-margin fields survive. Yet again, this is a short-term boost. Long-term demand is still slipping as more drivers plug into chargers instead of gas pumps. Third, there's innovation in fossil fuels themselves. Companies like ExxonMobil and Chevron are banking on technologies like carbon capture and storage, essentially sucking CO2 out of smokestacks and burying it underground. If that works at scale, oil could claim a clean label and win back some investor love. But these projects are still experimental, expensive, and years from widespread deployment. Finally, there's the wild card of new energy carriers, hydrogen and blue ammonia. Some see a future where natural gas or oil are used to produce low-carbon hydrogen, which fuels trucks, ships, or power plants. If the U.S. leads that charge, it could reinvent its fossil fuel base. But so far, these markets are tiny and face fierce competition from green hydrogen powered by renewables. Put it all together, and the path for a true U.S. oil revival is extremely narrow. A short window of policy shifts and technological breakthroughs. Miss that window, and the industry may be left chasing a market that has already moved on. When you zoom out, what we're really seeing is more than just a wobble in oil markets. It's a historic shift in how the world powers itself. Think of energy like a river. For over a century, that river was fed by oil and gas, always flowing, always reliable. But now, new streams of renewables and electric mobility have burst their banks, carving a different path. Solar panels, wind farms, and EV chargers are sprouting worldwide, changing the landscape of demand. Even if oil makes a momentary comeback, say through lifted tariffs or faster permitting, this river has already found a new course. Major oil forecasters like BP are predicting that global oil demand could peak this decade, never to return to its old highs. Automakers from Volkswagen to Ford are announcing plans to sell mostly electric cars within the next 10 years. That's like a whole industry turning off one river inlet at once. On top of that, governments from Europe to Asia are setting net zero targets, pushing for clean energy and penalizing high emissions. Investors, smelling the future, are redirecting trillions into green technologies, far more capital than oil companies have to spend on rigs and refineries. Put simply, even if oil prices bounce back temporarily, the long-term momentum runs away from fossil fuels. The tipping point has passed, demand growth is slowing. Alternatives are scaling, and policies favor clean energy. For U.S. oil, this means its future is no longer guaranteed by production alone. The world isn't just pausing on oil, it's planning to move on without it. And that reality will shape energy markets, geopolitics, and the economy for decades to come. Was Trump's trade war the spark that ignited the U.S. oil industry's collapse, or simply the first domino in a much larger energy transition? The International Energy Agency warns that global oil demand will be lower this year, largely due to the substantial risks posed by Trump's tariffs, signaling a structural shift rather than a temporary shock. Beyond trade barriers, Saudi Arabia's strategic price cuts during Trump's visits quietly supported U.S. inflation control goals, but also underscored how geopolitics can accelerate oil's downfall. Market analysis shows oil prices tumbled as the global trade war dented demand, with April 2025 data highlighting ongoing strain in the U.S. economy. Meanwhile, Goldman Sachs notes that Trump's push and pull on oil prices, from advocating lower costs for consumers to supporting producers near their $51 per barrel break-even, has added volatility, keeping investors on edge. Financially, U.S. shale's peak may have arrived. Major producers are scaling back as low prices discourage new drilling, marking the first annual production decline outside the COVID era. Critics argue Trump's tariffs inflicted lasting damage on international partnerships and supply chains, illustrating how policy blunders can ripple through the energy sector. Simultaneously, analyses from CSI's project that, without tariff relief, U.S.-China trade will contract sharply, further dampening market confidence in American oil. Industry sentiment mirrors this uncertainty. NPR reports that many oil executives, once optimistic about a Trump-driven boom, now worry about recession risks clouding prospects. Yet, the story doesn't end here. Oil companies are exploring carbon capture and alternative fuels. Regulatory shifts remain possible, and geopolitical tensions could realign markets. But one thing is clear. The forces set in motion by tariffs, competing producers, and the EV revolution have fundamentally altered oil's future. Join the conversation. Was Trump's trade war truly the catalyst, or merely one of many accelerants in oil's decline? Drop your thoughts in the comments below. And stay tuned for our next video, How Big Oil is Trying to Kill EVs, where we'll expose the industry's latest strategies to slow clean energy's rise.